Why some investors quietly grow wealth while others panic. A lot of people assume successful investing is mostly about intelligence, picking perfect stocks, timing the market perfectly, constantly analyzing trends, always finding the next opportunity before everyone else. But honestly, some long-term investing success comes from something much less dramatic: consistency. And in many cases, people with simpler investing approaches quietly outperform people constantly reacting emotionally to markets over long periods of time. That is important because modern investing culture often encourages constant stimulation: breaking news, market panic, trend chasing, predictions, fear, hype, urgency, and all of that emotional noise can slowly interfere with long-term decision making. Welcome to Nobody Told Us This, where we explore the patterns behind money, work, opportunity, and modern life. One reason simple investing approaches sometimes work surprisingly well is because simplicity reduces emotional interference. For example, some investors build habits around automatic contributions, long-term consistency, broad diversification, retirement investing, or repeated participation over many years. And because those systems are relatively simple, people may interfere with them less frequently. That matters because investing behavior often affects outcomes just as much as investment knowledge itself. And many people underestimate how emotionally difficult long-term investing can become during market drops, economic uncertainty, financial stress, or periods of fear and hype. The psychological trap of constant tinkering. This is where things become interesting psychologically. Many people believe more activity automatically creates better results. Constant adjustments, constant monitoring, constant reacting, constant optimization. But sometimes excessive emotional decision making creates instability instead, because humans naturally react emotionally to uncertainty. Fear increases during downturns, excitement increases during rallies, panic increases during volatility, and emotional reactions often lead people to buy high, sell low, change strategies repeatedly, or abandon long-term plans during stressful periods. That matters enormously because consistency becomes difficult when emotions constantly override systems. Another interesting dynamic is that some smaller investors naturally develop simpler investing habits because they have fewer resources available initially. That can sometimes lead to more automation, less overcomplication, fewer speculative moves, or stronger long-term consistency. For example, someone consistently contributing smaller amounts into long-term diversified investments over many years may gradually benefit from market participation, compounding, habit formation, and reduced emotional overmanagement. Again, this does not mean investing outcomes are determined simply by income level alone. Many factors influence long-term financial outcomes, including income, access to resources, time horizon, financial education, consistency, behavior, risk tolerance, and long-term decision-making habits. The larger point is that simple, disciplined investing systems and emotionally consistent behavior can become very powerful over long periods of time, regardless of where someone begins financially. The bigger point is that simple, disciplined systems can sometimes outperform emotionally inconsistent behavior over long periods of time. That is the real lesson. One of the most powerful investing tools is often automation, because automation reduces repeated emotional decision making. For example, automatic retirement contributions, scheduled investing, or recurring transfers can reduce the temptation to constantly time markets, wait for perfect moments, or react emotionally to headlines. That matters psychologically, because many people find financial consistency easier when positive habits are built into automatic systems instead of relying on constant manual decisions every month. And over long periods of time, consistency often compounds quietly. This is something many people underestimate. Long-term investing sounds simple conceptually, but emotionally, it can be very difficult because long-term thinking requires tolerating uncertainty, slow progress, market fluctuations, economic fear, and delayed gratification. Modern culture often rewards speed, immediate results, constant stimulation, and visible success. But compounding usually behaves differently. It often looks slow at first, quiet, uneventful, almost boring, and many people abandon long-term systems before the deeper effects of consistency fully emerge. That is important because sustainable investing often depends less on excitement and more on behavioral stability. Another important point, financial outcomes are not determined only by income level. Behavior matters too. Consistency matters. Spending patterns matter. Debt management matters. Emotional regulation matters. Long-term thinking matters. Automation matters. Two people can earn similar incomes while building completely different long-term financial trajectories depending on habits, systems, decision-making, and consistency. That does not mean structural economic challenges disappear. They absolutely matter, but behavior and systems still influence long-term outcomes significantly over time. The deeper lesson here is not small investors always win. The deeper lesson is that behavior often shapes financial outcomes more than people realize. And in many areas of life, simple systems repeated consistently can quietly outperform emotional inconsistency over long periods of time. That idea applies beyond investing. It applies to health, career growth, learning, financial stability, professional development, and even relationships. Consistency is often less exciting than intensity, but over time, consistency can become extremely powerful. Now, importantly, long-term investing is not only about understanding markets, it is also about building habits and systems that people can realistically sustain over time. And honestly, some of the most effective investing habits are surprisingly simple. Here are a few practical principles many consistent investors quietly focus on. Tip 1. Focus on consistency before perfection. Many people delay investing because they feel they need more money, perfect timing, or expert-level knowledge first. But often, consistency matters more than trying to create perfect conditions immediately. Small, repeated participation over long periods of time can become far more powerful than occasional bursts of emotional decision-making. Tip 2. Reduce emotional decision-making. Constantly reacting to headlines, panic, hype, or fear can create instability. Many long-term investors try to reduce unnecessary emotional reactions by creating systems, automating contributions, or focusing more on long-term participation than short-term noise. That does not eliminate risk, but it can reduce emotionally reactive behavior. For example, here are a few simple financial systems that support consistency over time. Automatic retirement contributions, scheduled investing dates, separate savings accounts, predetermined budgeting systems, long-term investing plans, contribution increase schedules after raises, emergency funds, or personal financial rules designed to reduce impulsive decision-making during stressful periods. These systems help create structure and consistency so financial decisions are not constantly driven by fear, hype, panic, or short-term emotion. Tip 3. Learn basic financial literacy gradually. People do not need to become financial experts overnight, but understanding compound growth, retirement accounts, diversification, fees, risk, and long-term investing behavior can become extremely valuable over time. Even small increases in financial understanding can improve long-term decision-making significantly. Tip 4. Avoid comparing your financial timeline to everyone else. One of the fastest ways people become discouraged financially is through constant comparison. Modern culture often highlights extreme wealth, rapid success, or unrealistic timelines. But many stable financial systems are built slowly, quietly, and often without dramatic visible moments early on. Tip 5. Build systems that continue working during stressful periods. Life becomes busy, motivation fluctuates, unexpected expenses happen, stressful periods happen. That is normal. Which is why many people focus on creating systems simple enough to continue functioning even during emotionally difficult periods, because long-term stability often depends less on intensity and more on sustainability. And honestly, that may be one of the most important financial lessons people can learn early. Simple systems repeated consistently over long periods of time can quietly become very powerful. One of the biggest misconceptions about financial growth is that success always looks dramatic. But honestly, many forms of long-term stability grow quietly through automation, consistency, repeated participation, reduced emotional decision-making, and systems people continue following even when motivation fluctuates. That is why behavioral systems matter so much, because humans are emotional, markets are emotional, news cycles are emotional, but strong systems can create stability inside emotionally unstable environments, and over time that stability can quietly compound. And if you enjoy conversations about financial psychology, modern work, systems thinking, investing behavior, and understanding how long-term stability is actually built, make sure to like, subscribe, and share this with someone who may find it helpful. This channel is about helping people understand money, work, opportunity, and modern life more clearly. And honestly, some of the most powerful financial systems are often the least dramatic ones.